Okay, so we've really got to talk. Today, we are looking at what's happening. Prices are up, it's all over the place, but you need to understand that there are a sequence of events that occurs. It depends on what happens leading up to these events. But I believe people are watching for hyperinflation when we should be looking for something else. Let's begin. This right here just shows us falling gas prices are raising hopes that inflation is slowing, New York Fed survey shows. You look at the next one, just basically showing us the same information. Gas prices keep plunging. Looking here at the US Strategic Petroleum Reserve, this has been declining at a dramatic rate. We haven't seen something like this. I mean, we're at the same levels from back in the late 70s. So these are a few factors. Now we watch this all the time. Gas prices is the one that affects people directly. They go to fill up the tank, they feel it. What comes next? Here it is. The world's hottest housing markets are facing a painful reset. Frothy property markets are poised for double-digit price declines as consumers face mounting financial pressures. There is one very important factor, and it cannot be discounted. And it is that when you have increased borrowing costs, when interest rate rises, when you have all these things occurring, people cannot afford what they used to. It is a simple matter of fact. It's because debt runs the system. When you take out a loan at the bank, they literally create that money. They created it out of thin air. They're able to do so because of the fractional reserve banking system. I'm sure you're aware of that, and I would love to discuss that further, but that's what we deal with. That's what we have. Increased borrowing costs, slower economy, slower prices, less growth, and so on. With real estate, that is very significant today. Let's break this down. I want to show you here what's happening. If you take a look, they're just going to give you a few examples. There's a few charts in here, but a lot of detail, okay? They're just saying that depending on where you are, you're probably feeling it, but it's from Sydney to Stockholm to Seattle. Buyers are pulling back as central banks raise interest rates at the fastest pace in decades. And I've shown you here time and time again that we have different central banks around the world. They're basically doing the same thing. They're going in this general direction, and that is tightening. The rapid cool down in real estate, a leading source of household wealth, threatens to worsen the global economic downturn. While the slump so far isn't near the level of 2008, how the decline plays out is a key variable for central bankers who want to tamp down inflation without hurting consumer confidence and triggering a deep recession. So basically, they've got to do it, but they don't want to bust up the housing prices. Well, as they mentioned here, you got Australia and Canada. Those are two places that they really rely on high prices for homes. Quote, we will observe a globally synchronized housing market downturn in 2023-2024. This is a former Bank of Japan economist, okay? And those, they know what they're talking about when it comes to inflating prices, that's for sure. Sellers often overlook signs of shrinking demand, and they don't want to do this. You could look at the example here that I have of that's just showing us the yellow line being Toronto specifically. This is one of the biggest, I mean, there's no way to deny it, but that is the biggest bubble in my opinion, because look at all these other places: Sydney, Auckland, Stockholm. All of them have come down in 2022 to quite a big degree here, and yet Toronto is just a little bit off the top. We need to see significant declines, and that would hurt those in Toronto significantly. Same with Vancouver, same with other areas as well. And so they go through this. I'm not going to read the whole article to you, but we are dealing with the same factors. Young families that have taken on debt have never experienced their lifetime a sharp rise in interest rates at a time when their real inflation-adjusted wages are falling. This comes at quite a shock, and that's really the key. That is so important because you can see what's happening. You've got people that have taken on way too much debt, as they mentioned here, just showing you the debt in relation to the interest rates and all of this. I think it is very worrisome to see this coming now at this time. Okay, look at this. Variable rate mortgages as a percentage of 2020 new loans. And you could see Australia, pretty much 100%. Spain is quite significant, over 50%. Canada, over 20%. UK, over 40%, and so on. Okay, so you see this is going to have an impact directly. Interest rate rises, it's going to hurt We know that. It already is, and we can see the demand beginning to fall. You see, there's hyperinflation that we got to worry about because of the central banks and the way that they act and what they intentionally want to do. But something has to come first. They have to really react. If you think you've seen inflation, my goodness, we haven't seen anything yet. Okay, if you look historically at what happens, it's going to be a problem. Now, let me show you something. Shipping's China syndrome. Demand sinks across multiple cargo markets. I'll show you those here in just a second. Container export growth drops. Imports of crude, iron ore, LNG are under pressure. So this is quite significant, of course, because the whole world watches what happens in China. Everything that they do, everything they consume is really looked at. They consume more than everybody else. And whether we are looking at container shipping here, you could see their exports did rise 7.1%. That's great, right? But you look at what's happening here, the volume index, it has come down quite a bit over the last little while. And it's not because of seasonal factors either. This would typically be starting to ramp up into a very, very busy time, in fact. Dry bulk imports, looking at this was down 6.1%. Oil imports, and it goes on and on, okay? And all I'm trying to highlight here is that on many, many factors, these have declined to a great degree. And this is only the beginning, and things could turn around. You know, they have lockdowns, they have this, but is it that, or is it an actual slowdown in demand? And I'm going to show you some more explanation of what's occurring. Take a look. Here we have cost reduction program and management changes. What does that sound like to you? Cost reduction program. That's right. Management changes too. Electrolux, they're basically, doing a few things to cut costs. What do you normally do when you got to cut costs? Well, you start looking around. What don't we need anymore? Okay, do we need that? Do we need that? What are those things that just don't sell, those products that don't sell? Let's get rid of them. We're spending money to keep them. They're in the inventory. Let's push them out. At the same time, they got to get and decide, hey, that thing we tried? Yeah, it's just not working out. Let's cut it. Let's cut that whole department. They start laying off people. They lay off the poor performers. That's occurring right now in major companies. Electrolux, second biggest manufacturer of appliances, I believe. Inventory to sales ratio at other general merchandise retailers. So you imagine retail, whatever it's Best Buy or what have you, these big box store type things are just carrying this massive level of inventory because they had to order a whole bunch in 2020. They tried, they couldn't get it in by the time the orders came through 2021. Now it's just piling up. It is not what we were told it was all going to be. Oh, yeah, the booming economy. Well, to a certain degree and for a certain group of people, not for everybody. Goldman Sachs, okay, the vampire squid, prepares for layoffs as deal making slows. The bank reported in July that its profit had fallen because of shakier economic conditions. Wait a minute, you mean Goldman Sachs is not impervious to all of this? Look, they're the same as everybody else. They operate in a different way on the surface level, okay? They're going to operate in this way where, yes, they have the connections in the government and many governments, and they're going to do what they need to do, but you got to look at this very specifically, and that is they're doing what the other companies are doing too. They're starting to trim. It's not significant. We're not at 2008 levels, but this is coming at a time in which you got rising borrowing costs. They are not going to be able to be impervious to it all, so just be mindful of that. Here we have EU ministers call for a 10% cut in energy consumption. What did I just say here? That they are calling for cuts to your energy. And how is that going to work exactly? Do you get to leave your lights on and you're allowed to heat your home and your neighbor isn't? Or is the government going to tell you what you can and cannot do? EU energy ministers are calling for a 10% reduction in electricity consumption. Today, an emergency meeting is just the latest of many efforts the EU has made to quash economic upheaval due to the industry shutdowns and prevent protests due to the skyrocketing energy prices. Whatever actions they take, it will actually only exacerbate. It would only make the situation worse. That has happened every single instance for the most part. If you look at these factors here. What's happening? You've got the central banks all this time printed on money. You've got the super low interest rates for the long period of time, so long in fact that it starts to create all these distortions and wild factors that we've never seen before. And then we have an energy crisis on top of that, and then we have supply chain problems, and then we have businesses doing this and geopolitical events and everything else. But let us not forget what came first. Okay, because for so long they've been devaluing the currency and keeping things out of whack. By artificially maintaining low interest rates, you create this. Now, what is the Federal Reserve, what are the other central banks really trying to do? They're trying to lift borrowing costs so that they can slow things down. They are intentionally trying to create a very mild, they're not going to say it, but they're trying to create a mild recession. At least this is like surface level stuff. That is not going to end up well, because you generally don't create a mild recession, you create a painful one, okay? This was something I just wanted to bring up really quickly. The generational divide on quiet quitting. So what we're seeing here is different age groups, 18 to 29, all the way up to 65 plus. And then it's broken up into two different sections. Okay, the left one says employees should always go above and beyond at work. And essentially, the older the group is, the more they believe that. And the opposite end of the spectrum, it says employees should do the work that they're paid for. No more, no less. And it has the exact opposite situation, where the youngest group of people agree with that the most. So what does this tell you about what's happening today and where we are in the future, where people are not going to basically deal with what individuals did 20, 30, 40, 50 years ago, and they're just going to go their own way. Which way will they go? That's the big concern of mine. You've got this situation here directly connected in with it. En route, Uber Eats ditches delivery drivers and rolls out self-driving cars in weeks in 2 states. Is it coming for your city? Okay, not a glamorous job, I understand. So you got Uber Eats, you got all the food delivery, you got the taxis, these things, autonomous driving. I don't think it's really past any safety, but whatever. Stay off the roads, I guess. What it's like to eat at Mesley, a San Francisco new autonomous robot restaurant. So this is becoming extremely popular. We're going to see this everywhere. No longer do you have to wait for the hair to fall in your food or somebody to do something all tricky in there. You're going to get a robot to do it. And for takeout, like in this situation here, you're not sitting down at a Michelin star restaurant. This is the kind of thing that it may actually do very, very well. Now, I want to talk about what's happening and, of course, solutions. Let me discuss that right here. Important to make it happen. Okay, there are a few points I want to cover right here. Have a secondary source of income if possible. You need more income right now just to keep up with what you said, with what you've had before, okay? Own real assets. Physical, tangible goods are always going to do better in these circumstances, whether it's deflation or whether it's inflation. Invest in the things that are going up in price, okay? If oil's going up in price, you could invest in it. I'm not saying to do that. I'm not giving you financial advice. I'm saying if you think something's going to go up over the next 6 months, 12 months, 24 months, you put your money into that and you hold it there for that duration, or at least a small percentage of it. Spend time learning skills, not entertainment. And I understand people want to be entertained. I get it. I understand, okay? But this is just what I'm telling you. These are just a few points that I wanted to make. I know it's the broken record GPS. I got you, okay? But what we're looking at right here is just a simple repetition to get that through our heads. And I hope that some of this information was valuable to you. Did you find it valuable? If so, I would appreciate it if you subscribe, because I'm going to bring you the latest and the greatest details, and I'll break that down. This channel is going to continue to evolve. I want you to be here with me. See you on the next one. Take care.